Hello everyone, it's Davide here and welcome back to Learning Finance. In today's video guys, I want to do an update on my Chinese holdings. So we are gonna talk a little bit about Alibaba stock, but mostly about JD.com, which yesterday they released earnings, and it looks like that the stock at the moment is gaining a little bit of momentum back, so at least trying to show some strength after this drop that if you follow the channel, you know that I made previous videos. I told you, look, now the situation with the valuation is starting to become silly, in my opinion. So we are gonna see actually if JD will be able to resist a bit in the coming days. Anyway, we're gonna take a look at some numbers, try to update the valuation. The only thing I ask you guys, as always, is please leave me an early like. It's very important and I thank you for it. And subscribe to the channel so you don't miss any new updates. Let's begin. Alright guys, very quickly, Alibaba stock. I made a video about it after earnings, so if you want to see the video, actually go on and check it out if you haven't already. But the stock was dropping like a stone because they reported first loss due to the fine, and I told you that, well, this positive trend going on since 2018 is something important, and that Alibaba probably would be able to maintain it, okay, hopefully at least. And it looks like the Alibaba found a bottom on $204 per share. Now it's trying to bounce back. So as of now, we can say that the stock has maintained the long-term positive trend. Now, the valuation in terms of fundamentals, obviously I told you how here things make no sense. Well, okay, there are risks, Chinese uncertainties, delisting, all this kind of stuff, but let's be honest, here Alibaba is extremely cheap in my opinion in terms of business. So we are gonna take a look if Alibaba will be able to maintain finally this long-term trend, find a bottom to all this negative situation and maybe try to recover or at least not drop anymore in the coming months. Now let's talk about JD. So when it comes to earnings, JD released for Q1 2021 $31 billion in revenue, an increase of 39% from the first quarter of 2020. In the same period, they have increased their annual active customers almost 500 million, an increase of 29%. They have done also interesting partnerships. One of them is with Louis Vuitton, launched in April. If you remember, JD, differently from Alibaba and Pinduoduo, is a platform when you go there if you want to buy brand items, so luxury stuff, or as well as iPhones, for example, differently from Pinduoduo where you go there to buy cheap stuff. Another interesting partnership is the one with Tencent, so a mixture of Tencent and JD Logistic formed JD Tencent Cloud Warehouse. We know that JD Logistics has more than 1,000 warehouses, so the infrastructure that they built over the years is massive, is obviously the biggest in China in terms of e-commerce infrastructure, and interestingly is that most of it is automated. Now that makes me think that probably moving forward they will be able to increase margins with automation. In terms of margins, this is the problem. JD as of now is not able to push those margins higher. The income from operation in first quarter has been lower. Okay, so 1.7 billion RMB, which they are around $300 million, compared to 2.3 billion RMB in previous Q1, okay, so 2020. Clearly is not something that we want to see. This is the result of an increase in costs, which is higher than the revenue growth. So as we can see, cost of revenues went up by 40.7%. So clearly if you compare that with a 39% growth, but I went on and drew a breakdown on those costs, trying to see which costs went higher in order to try to understand whether it's something to be worried about or maybe not. So I'm gonna show you in just a second. Before to take a look at that, just when it comes to revenue, we see that the net product revenues increased by 34.7%, while net service revenues increased by 73%. Why is this significant? Because JD has higher margin here. Okay, so seeing that increasing more, something positive for the future, meaning that probably JD can increase margins moving forward. But anyway, let's take a look at the costs. I put RMB because I didn't want to make a mess with US dollars in terms of change, currency change. So here is more clear in my opinion. Now, net revenues, we had a growth of basically 39%, okay, as they said. Now, the cost of revenues, 40.70%. However, in this cost of revenue, we have the most important, in my opinion, to try to understand whether JD is able to scale moving forward or not. And this is the fulfillment costs. So the main issue with those kind of business plan is the high costs when it comes to fulfillment, because they have the infrastructure, they make the packages, all this kind of stuff, deliveries. That's basically the difference with Alibaba. Is the same difference that we had in the past between Amazon and eBay in the US. The fulfillment costs went higher by 32.73% compared with a 39% growth in revenues. This is something, in my opinion, that we like to see. It means that as JD continues to grow, they are able to do more revenues by spending less in their fulfillment process. This is one of the key ways for JD to scale in the future. So this is something that's interesting. Which one is the cost that went higher significantly? That's the marketing costs, which went up 56.40%. So this is significant when it comes to deduct and find the operating income. However, marketing expenses are not something bad for a business. So this is a cost, okay, but it's something for the future. So it's an investment. While this one is a cost of the business, that's an investment basically. So you can take a look at it like that. So yes, it went up higher than the growth rate, but it's fine. Then R&D grew by 15%, but this is not the one significant in the impact. The other significant is general and administrative costs. However, they are still lower compared to other costs in terms of the real numbers over there. Anyway, went up 56.70% for first quarter. Now here, guys, when it comes to the valuation, I still have the old valuation that I made in previous videos, trying to make you understand what the market was pricing. We can see that for the first quarter, free cash flow is negative. Now, this is something that JD usually does because the business is cyclical. Now, what is important is that for the 12 months period, we have positive cash flow, so 4.3 billion for JD, considered the Q1 loss. So when we take a look at the valuation, actually for 2021, here I have estimated a 4.79 billion in free cash flow. It would be a 3.5% free cash flow yield on the revenues. Now, 2020, they have done 4.68%, so 5.3 billion. Here, I am lower. I think that they will increase that in Q2, Q3, and Q4 especially. But as of now, I want to remain lower. This is the valuation that I did in previous video to show you what the market was pricing. We still have 137 billion in 2021. Now, the market expectations are higher, so 147.16 billion for 2021 and 179 billion for 2022. But in this valuation, actually, they are still 137 and 157.5. Then, if you remember, I put a growth rate of around 15% until 2024 and then dropping to 10% to 2028. And I told you, look, let's assume that JD will never be able to scale. Okay, so let's keep a 3.5% free cash flow forever without any scaling improvements. By taking these free cash flows, what we had was a $72 as a fair price. That, in my opinion, was probably the worst case scenario for JD. So no scalability and a revenue drop, significant drop from basically 2021, even worse after 2024 moving forward. But the stock went to 66. So I told you, look, here valuation are starting to become silly. However, let's try now to do a valuation according to what they said in earnings, what analysts are expecting, and also trying to put a little bit of scaling. Okay, so nothing crazy, but just let's say that moving forward, JD will be able to scale, because right now the Chinese e-commerce market is fragmented. So we have multiple e-commerce which are trying to take market shares. Okay, the market is still considered to increase in the next 5 years. As of now, they are also spending, as you have just seen, on marketing, so they have increased that significantly. But moving forward, so like for example from 2024, well, maybe they can start to scale a bit. Remember also that a lot of warehouses for JDs are automated. So as long as AI, technology, robotic will continue to improve, it's very likely that JD will put costs down when it comes to fulfillment. So let's keep that scenario. Now, first of all, let's put analysts' expectations over there. Here we go. Let's keep the growth the same for the other years. Okay, so 15% 2024 and then dropping to 10 in order to be very conservative. Then the free cash flow yield, let's say it remains the same for another couple of years, so without scaling. And then it begins to improve, but improve not significantly. Okay, so something like that, 3.7, 3.9, then let's say 4.10, arriving at a 5 in 2028. So nothing crazy, because look, in 2020 they have done 4.68%. So 5 in 2028 is achievable. Let's take those free cash flow and see what we get by taking the same requirements. So 11% discount rate, perpetual growth 3.5% after 2028, a fair price today of $108 per share, basically. And now, considering that JD today is around 73, it means that is undervalued at least 33%. Upside potential to the fair price of almost 48%. Now, this is not crazy in my opinion. Okay, this is not bullish. This is, in my opinion, something normal. It's something that JD can do. It's nothing crazy with margins. It's nothing crazy with growth. Let's just try to, for example, instead of 15% here 2023 and 2024, let's just be a little bit more up with some numbers. So 18% maybe. Okay, and then instead of 10, let's just put, I don't know, 11. Just let's be less conservative with those numbers. That, in my opinion, this is something that JD can do without any problems by keeping the scalability exactly the same, so $116 per share. So you see how if JD continues to go on and do positive earnings without expecting anything too crazy, the stock is undervalued. Okay, there is nothing to say about that. I mean, that's it. Now, clearly, we still have issues with China, all of that, uncertainties, delisting, blah, 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 government rules, all of that. But this is what is making those kind of companies cheap. And plus, those growth rates over there, well, 11% by 2025, I don't know that. Amazon grew a lot, okay? It's continuing very near to 20+%. So I'm not saying that JD will do the same, but well, the Chinese market is basically bigger than the market of Amazon together with US and Europe. So, well, China will add lots of people to middle class. They like to spend, they like brand items, they really like technology, they like to dress properly. So in my opinion, guys, this is a company that it continues to remain undervalued. I will obviously continue to hold in my portfolio and I'm not planning to sell anywhere soon. So you asked for an update on earnings. That's my opinion, guys. Leave me down a comment with your opinion. I hope you find the video interesting and subscribe to the channel if you want. And as always, guys, have a wonderful day.